welcome to Australia's post-market show. You are watching Trading Matters and I'm Maddie Drury. The Australian market has just closed out. The shares are settling just mildly to the upside right now at 45.39. It's been a bit of a choppy day, as you can clearly see from the chart. Well, coming up after 2 years of reduced earnings, we'll debate whether the Australian banks have turned a corner towards positive earnings growth. Plus, our guests will name their preferred buy across the Aussie banking sector. That will be with Peter Burrows, Executive Director at Bell Potter, and Sean Fenton, Portfolio Manager at Tribeca Investment Partners. But first, here are today's headlines.
Impairment charges, we believe they've likely peaked. That third quarter was our highest for us. We see signs of stabilisation.
A confident outlook. Westpac is the first among the major Australian banks to call the peak of the bad debt cycle after unveiling full-year cash earnings of $4.6 billion. The tough talk continues. Telstra tells shareholders it's holding a very firm stance in negotiations with the Aussie government over its proposed broadband network, warning a functional breakup of the telco could cost as much as $1.2 billion. And doubts grow over a December rate hike. Retail sales record a surprise drop in September as the impact of the government stimulus fades, causing some investors to pull back their bets on another rate rise this year. Well, to our top story first of all. In the banking industry's most positive outlook yet, Westpac says the bad and doubtful debt cycle has likely peaked after beating expectations with a full-year cash profit of $4.6 billion. Well, checking in on Westpac shares right now, at the end of trade today, they've settled to the upside by 1.5% at 25 Australian dollars and 80 cents. Well, while Westpac put forward a solid result, bad debt still weighed on the bank, with impairment charges spiking to $3.2 billion from $931 million just a year earlier. Speaking to CNBC, CEO Gail Kelly explained why she believes bad debts have likely hit their peak.
By the time we got to the fourth quarter, we'd seen some stabilisation, so a slowing in the growth of our watch list assets, for example, and really an opportunity to be really right across our portfolio, so across the secondary watch list, across the watch list itself, and just seeing a slight improvement and stabilisation there.
Well, what do our guests think about Westpac? Let's ask them. Gentlemen, thank you very much for joining us today. Peter, let me ask you first of all, what did you think of the result from Westpac?
I think it was above most of our expectations. The dividend was certainly above virtually anybody's expectations to increase from 56 to 60 cents. That was great news, but the really good news in the result, I think, was where the provisioning is at. Gail's called the peak in the bad debt cycle, and I suspect now we're going to find, as in the next result and the one after, that they've actually over-provisioned. That's the sort of elephant in the room in this result. You know, how much have they over-provisioned?
Is it better to be cautious, though?
Oh, absolutely better to be cautious, but we're going to see a big increase in profit over the next 2 years from these banks.
Do you agree with that, Sean?
Certainly, I think bad debts have peaked. They're going to be wound back to an extent. I'm not entirely sure that they'll really fade away too quickly, though. There's still a lot of weakness out there in the economy. We're going through a lot of turbulence globally, so I think they might come down a bit more slowly than people are expecting. I think the real question on the banks is, what do you pay for them at the moment? They've had a huge run. Dividend yields have plummeted down towards 4%. There's not really a lot of value there at the moment.
Absolutely. I mean, the banks as a whole, I think, have moved at almost double the pace of the broader market over the course of the 8-month rally. But still, would Westpac be a buy for you, Peter?
It's our pick of the banking sector.
But it's not a buy.
Well, no, none of them are bargains. There are Ps of 15.5 to 16.5 and yields of under 5. So prima facie, that they don't look cheap. And yes, they have outpaced the market considerably. But looking 2 years ahead, you're going to see earnings increase by some 20 to 25% in 2011. If you take that into account, they're trading on Ps in 2011 of about 12.
So even if it's the pick of the banking sector for you, is it just a hold? It's not a screaming buy. What about you? Buy, sell or hold?
I've got sort of hold to sell across most of the sector. NAB's probably my preference, but a reasonably weak one at the moment. The major banks, they've got different characteristics in terms of risk and reward. I think NAB's probably got the biggest potential for rebound as the UK starts to stabilise. Also, their high presence in business banking in Australia and margin expansion there. So it might do a little bit better in terms of earnings growth, but it's a little bit riskier as well.
And I guess all these different exposures amongst the banks also means that their bad debt cycles have slightly different peaks, don't they? We'll get back to the broader banking sector in just one moment, but I do want to get to the rest of the market action. We've seen some pretty choppy trade around the region after the Dow failed to push into positive territory. A quick run through for you. US stocks, as you can see on the board, ended mixed. Investors took a bit of a cautious position ahead of the Fed's interest rate announcement and the all-important statement as well. By the bell, the Dow had slipped 0.2%, the S&P and the Nasdaq marginally in the green. News of Warren Buffett's biggest acquisition ever made the loudest noise on Wall Street, with Berkshire Hathaway paying $26 billion to buy out Burlington Northern Railroad. Buffett said the move was a bet on the US economic recovery. Gold also made headlines for all the right reasons, surging to a record high above 1,080 a troy ounce after India's central bank bought 200 tons of gold from the IMF for $6.7 billion US. Right now, we're at 1,084 a troy ounce. As for the Australian market, well, after initially climbing around 0.5%, the market retreated, with investors a little concerned about Wall Street's ongoing correction. Let's get straight out to CNBC's Matthew Taylor, who has been watching all the action since the moment the gates opened. Hi there, Matt.
Hi there, Mandy. Hi, everyone. Yeah, a bit of a choppy session for the local market, as you were saying, moving in and out of the plus column. But as we sit right now, it does look as though we will end to the upside by about 0.2%. We're higher by around 8 points at 4,533. The high point for the day, 45.59. The low, 45.18. The banks really helped us out quite significantly today. You were mentioning that Westpac result. Let's show you how all the banks did. Westpac certainly the outperformer amongst that space. Telstra holding its annual meeting today. Now, this is really the first time that shareholders have been able to speak to management since the government announced its reform plans for the telecommunications space here in Australia. Now, Telstra saying that it does expect both top and bottom line growth, but said it would not agree to this separation of its separate divisions unless it added value to shareholders. Here's some of what the CEO, David Thodey, had to say at the AGM today. Take a listen.
What I can absolutely assure you of is that the board and management will not agree to any proposals on the NBN or separation unless we are convinced that it will deliver fair value for you, the shareholders of this company.
Let's show you how the resource space performed because, Mandy, you were just mentioning the strong gold price that we saw in the overnight session. Let's show you how BHP finished up the day, Rio Tinto, all of those stocks modestly to the upside, Woodside lower. But let's flip the board and show you how the gold stocks performed because it really was a very strong session for all of those gold stocks. We saw the likes of Newcrest Mining up by around 4%, Newmont up by a similar amount, Lihir and Sino up by around 5%. We also got some economic news today. Retail sales unexpectedly falling in the month of September. They were down by 0.2%. The market was looking for a gain of around 0.4%. But we did see building approvals come in stronger than expected, up 2.7% in the same month. The market was looking for about a 2.5% gain. Aussie dollar pulling back a little bit on the back of that weaker retail sales number. Right now, 90.26 against the greenback. Mandy, back over to you.
Thank you so much for that, Matthew Taylor. Well, let's get back to our guests right now. This time, Sean, let me start with you. Do you think that Telstra is correct in digging its heels in, and what are the share price implications?
Certainly it needs to negotiate the best value in terms of the assets that it does put into NBN. Yeah, it's a very interesting standoff at the moment. The government's trying to really cut down the amount of subsidies that it's got to throw into to make that work, and Telstra's trying to get the best value for shareholders. You know, the government's got a big regulatory stick, and Telstra currently own the assets, so we'll see where it all pans out. But I think there's a lot discounted into the share price, so we'll get some clarity there probably early next year, and I think Telstra starts to recover from there. So
if all these shenanigans are already discounted in the share price, what does that mean in terms of implications for whether it being a buy for you right now? Oh, I think it is a buy. It's when you've got that uncertainty into the market that people panic a little bit and won't look at a stock that gives you the opportunity to take a little bit of a longer term view, buy it at a very low multiple, yielding close to 10%, fully franked. It's a pretty strong buy. At times of most uncertainty are the times of most opportunity. Would you agree with that, Peter?
Oh, absolutely. I mean, Telstra's been the one large cap stock you should not have had in your portfolio this year. It's underperformed the market dramatically. I think it's a great buy now. I think it's extraordinary value, and I think the bear case is very fully priced into it. Yes, there's a lot of uncertainty still, and as Sean says, we'll probably have a much more certain lead early next year. But at these multiples and yield, and a very sustainable yield of nearly 9%, it's great buying.
Would you stick your neck out and put a price target on it, say in 12 months' time?
I'd be happy to put $4 on it in 12 months' time. And that's terrific appreciation from 324.
Indeed it would be. OK, we'll get back to both of you in just 1 second. If you have a question or a comment for our guests, you can email us. tradingmatters@cnbc.com is the email address. Well, coming up on Trading Matters, we're going to speak to PwC's Mike Codling about why he says Australia's big four banks have turned a corner towards positive earnings growth. Plus, both Peter and Sean say the bad debt cycle is at the peak, but we'll debate how quickly bad debts can come back down. Also, just ahead, we'll check in on the Asian market action with CNBC's Sejal Patel.
Hey, Mandy. Well, it is mostly a positive picture here in Asia. Some signs of caution ahead of that Fed policy decision later today. South Korean banks rallying on some solid reports, and Nissan set to report results. I'll give you the preview when we come back.
What the world needs now is energy. The energy to get the economy humming again.
And the dividend was also increased at 2 cents for the year. Based on current prices, the stock trades in a PE of around 6 times and a fully franked dividend yield of 8%, which I think is good value.
We should mention that Adrian does have holdings in that stock. Let's get back to our guests for their final picks. Gentlemen, we've already talked about Telstra, and you both like Telstra. Peter, tell us about your other two in your basket of top tips.
Well, the other two large caps are CSL, where it's been downgraded on currency issues. So much of its earnings are offshore and in US dollars. I think that's partly mistaken in that they're buying blood plasma product for Europe from US, and they've got the currency advantage and the strength of the euro relative to the US dollar. Gardasil and Influenza are great long-term investments for them, great products. There's still significant earnings growth there. They're halfway through a massive buyback of their own stock. That not only underpins the price, I think it's cheap. And Woolworths is just quality, quality, quality. Australia's best retailer. Come back from 30.5 to under 28, it's cheap.
Not wow for nothing then.
Not wow for nothing.
What about you, Sean?
Look, I quite like media at the moment. I think it's got great leverage to economic recovery. It's been led into the cycle very early, and it's got great earnings potential on the upside. So News Corp's a stock there, a very big, lot of liquidity.
We've got the earnings tonight, don't we?
We've got the earnings tonight as well, and you know, Rupert's been reasonably upbeat for the last couple of results, so we might get some more good news out of him.
And Pacific Brands, just really quickly?
Pacific Brands, it's a retailer, very much a turnaround story, recapitalised, debt under control, taking costs out and benefiting from strong currency.
Wonderful. To both of you, thank you very much for joining us today. Peter Burrows from Bell Potter and Sean Fenton from Tribeca Investment Partners. That does it for us today on Trading Matters. Make sure you tune in tomorrow. We'll discuss where to find the best investment opportunities on the Japanese markets. See you then.
The Currency Challenge update was brought to you by FXCM. Start trading currency with FXCM, the official sponsor of the CNBC Currency Challenge. Sign up today and receive a $100 bonus. FXCM offers no requotes from dealers and over 30 market indicators. Visit fxcm.com.au for more details.
Hello, I'm Rick Stein, and I've got to tell you, this month looks great.
This November on Lifestyle Food.
It's a foodie's delight.
Top chefs compete to cook for the homecoming banquet.
This is the sort of complete showstopper.
In the finals week of Great British Menu.
Tastiest adventure yet.
Trish savours the spirit of seasonal delights.
Everything pure and natural.
In a brand new series, Trish's French Country Kitchen.
I'd like you to meet some true heroes.
As the kitchen stadium hunts for a new warrior.
Find out how these chefs create under pressure.
In a brand new series, The Next Iron Chef.
So, take your pick from the menu.
We're entertaining every day this November
on Lifestyle Food.
Where are the opportunities for investors in these markets?
There's some great brands at good prices if you have a long-term time horizon.
We're expecting earnings to bounce anywhere between 30 to 40% over the next couple of years.
You've missed your best 6 months of your lifetime.
There are still opportunities out there, let me remind you.
Trading Matters, your essential guide to the Australian equity market. Weekdays at 4. The real world affects the financial market.